All right, Jeremy, thank you so much for being here on the Saltivation Podcast. It's great to have you here.
Thanks so much. It's great to be here.
So, we know you have some private sector experience in your background. Can you tell us about it, what you've done, how you got to where you are, and just let us get to know you a little bit?
Certainly. So as a professional tax practitioner, I've taken sort of a non-traditional route to get where I am. So I did go to business school, and then I went and did a law degree at the University of New Brunswick here in Canada. I practiced for a while with a local municipal government, but I had always had an interest and a passion for tax. That was sort of my focus in my undergrad degree and then in my law school program. So after practicing for a period of time with the local municipality, I actually went to a mid-tier accounting firm. Spent a number of years there in the tax department, really refining my tax skills. But interestingly enough, I focused not necessarily on corporate tax or income tax like most tax practitioners do. I actually focused on what we in Canada call either sales tax or commodity tax or indirect taxes. We kind of have a bit of an identity crisis. So we're always trying to figure out who we are. But generally, I will refer to us as sales tax practitioners. So I practiced sales tax within a large public accounting firm for a number of years. And then my largest client at the time happened to be the number 2 grocery store in Canada, so publicly traded company with about $20 billion a year in sales. They got, frankly, tired of paying consulting fees and asked me to join them. So I joined, at that point in time, it was the Sobeys group of companies. I joined Sobeys as their head of indirect tax, ran that tax department for about 8 years, and then for the last couple of years of my career at Sobeys, I was the head of the entire tax department. So I took on corporate tax, customs, those sorts of things as well. So for about 10 years, I was on the inside, trying to manage tax compliance, tax risk. We had a team of about 20 professionals, and we were always focused on, processes and risk management and identifying risks and opportunities. And in addition to, running the tax department for a large wholesaler and retailer, we also did a number of transactions and acquisitions during that time. So I was involved with some really interesting transactions. We acquired Canada Safeway. I think that was a $6 billion acquisition. So was involved with a lot of day-to-day operations and then a lot of acquisitions as well. So it was really interesting. And then after doing that for about a decade, I took my experience and headed back out to be a consultant and advisor and tax practitioner again. And here I am 5 years later, still practicing within my own law firm. So that's kind of my background as to how I got here. And I do think it allows me to add a unique perspective when I'm talking to clients. I understand not only the tax technical and the dealing with the tax authorities as most tax practitioners do, but I was also on the inside. So I've got the practical experience dealing with tax teams or with, the non-tax teams and accounting folk that you have to deal with inside of organizations.
Well, yeah, so you can speak to both. It's like, yeah, and we kind of find ourselves in the same boat where it's like, here as a practitioner, I need to tell you the technically correct answer, the legal answer, but then there's the application perspective of, right, we'll appreciate that, you might not be set up to do everything everywhere right now. And so where can we, reasonably from a business perspective, take that business perspective?
Yeah, that's right.
And,
So I ran into
be
that.
compliant.
Yeah, I ran into that a lot with it's one thing to have sort of the tax technical memo and understand how the rules work. It can be another thing to actually implement the rules throughout, your operational arm, not just the finance arm, but the operations arm as well of most businesses. So always a challenge.
So, us as practitioners, state and local tax practitioners, we're, even though Meredith and I physically sit in Colorado and we have some Colorado-based clients, we are multi-state. So understanding that, Canada has its provinces and everything, I'm guessing from your experience, you're very well versed in all the different taxes for all the provinces.
Yeah, that is a fair statement. So Canada's geographically large. So obviously the country we have a national sales tax, and I can talk about that in a little bit. But we, in addition to the national levels of sales tax, we also have 10 provinces and 3 territories that all levy their own sort of provincial or territorial taxes as well. So really what I would say for most international businesses, so I do deal quite frequently with international businesses who have a Canadian branch or have sort of a Canadian geographic region. And a lot of times, it's a US company or a European company, and maybe 3, 5, 10% of their sales are in Canada. So they have just enough sales in Canada to need to care about Canadian tax, but don't necessarily have Canadian tax practitioners on staff. So really what I often talk to those folks about is I say, look, in Canada, we have a national sales tax that almost everybody needs to think about. We call it the GST, the goods and services tax. It's a value added tax, so it is recoverable throughout the supply chain, which isn't always something that my US clients think about as much as the European
Sure.
ones do. The Europeans are a little more familiar with the value added tax system, but in Canada, we have a national value added sales tax called the GST. And in 5 of the Canadian provinces, they have done away with their old provincial sales taxes and have actually harmonized their sales taxes with with the federal GST. So federal GST applies across the country at 5%. Except if you get into one of those provinces that have harmonized their tax. So in some instances, it's harmonized at 15%. Some instances, it's like Ontario is harmonized at 13%. So the nice thing about a value-added tax regime like that is once you're registered once, you're registered across the country. So whether you have sales on the East Coast, the West Coast, Central Canada, you're registered for one regime and you're collecting and reporting all of that tax through one mechanism. Outside of the federal GST, we do have 4 provinces that have their own provincial sales taxes still. So we have the province of Quebec. They have a Quebec sales tax that effectively mirrors the GST. So it applies in very much the same way. And it's also a value-added tax. So Quebec is, you can think of them as being somewhat harmonized because the rules are harmonized, but the administration is still separate. And then we do have 3 other provinces, British Columbia, Manitoba, and Saskatchewan, that all have provincial sales taxes that would operate much more similarly to state sales tax in the US. So those are sort of the broad strokes for what we have in Canada. We do have a number of excise taxes as well that are sort of item specific. So excise taxes at the federal and provincial levels on products like fuel or tobacco or alcohol, those sorts of things.
Sure. And then, as far as definitions and taxability and things like that, I mean, are those pretty similar even amongst the provinces that have their own sales tax?
Yeah, so unfortunately they're not. So for
Of course they're not.
yeah, exactly, right. So for the GST HST that applies nationally and the Quebec sales tax, which like I said somewhat mirrors the same rules, a lot of the definitions are the same, and the short story is all goods or services are subject to the GST or the QST in Quebec, except for a number of numerated items that are tax exempt. Once you get into British Columbia, Manitoba, Saskatchewan, those provinces with their own PSTs, all bets are off, so to speak. So they've all got their own PST legislation. The PST legislation in those provinces has been around for a really long time. And they've all kind of, separate legislation, separate taxing jurisdictions, separate policy reasons for why and how they do things. So unfortunately, we do have a number of different sets of rules that have to be sort of managed and reviewed accordingly.
Well, that's not unlike our states here in the US. So not a huge surprise, but and even our locals, obviously, too. So, in the state of Colorado, we've got local taxes, like the cities. A lot of the cities have their own, and their rules can vary even from the states. So just goes to show that, we're not necessarily unique in that way.
Yeah, and I would say, so in Canada, we have less of that local taxing jurisdiction. So at the municipal level, you don't see it as much. We do have sort of annual property taxes that are levied on property owners, but as sort of a transaction tax, there's not really all that much at the municipal level. Some municipalities are starting to create their own municipal taxes on things like hotel levies, or in some instances Airbnb type levies. But
Mhm.
other than that, we're generally not seeing a lot of tax at that sort of municipal jurisdictional level in Canada yet. And one of the things I do like to point out for a lot of my US based clients is in the US, and I remember this from my days of being the head of tax at sort of a public company in Canada that had some operations in the US, right? We would talk about all the many thousands of different sales taxes that you can find across the US, and you can often find robust service providers, tax engines to help you manage those processes. Um, Given Canada's relatively small population in comparison to the US and our relatively limited number of taxing jurisdictions and applicable taxes, we typically find that the tax engine software isn't as robust in Canada as it might be in the US. So what we are finding, or what I find, is that you'll have organizations, businesses, taxpayers who need a little bit more of the tax specialist support because they can't necessarily get as much information from the tax engines. Now, it doesn't mean that the tax engines don't have some Canadian support. They certainly do. It's just I don't think there's as many options and as many ideal options as there are for U.S. taxes.
So then would you find that taxpayers are kind of manually computing it?
I would
Or
say they're um, using technology to compute the taxes, but they are probably a little more manual in their tax determinations at the front end. So if you've got a client that's using like a software package like SAP, for example, determining their tax coding in the system when they're going to charge GST or when they're going to charge British Columbia's provincial sales tax, they're making that determination a little more manually than you would see, I think, in the US, where you can get a bit better support on helping organizations determine when to turn the tax on or turn it off.
well, and I guess and then kind of speaking to like turning that tax on or off, like what creates the duty to have to be subject to, right? There's the national, but
Yeah.
to be subject to sales tax, right? Like as a result of Wayfair in 2018, states have kind of a bright line threshold of, generically 200 transactions or $100,000 in sales. Is there kind of a similar threshold, or what's the impetus of having to collect
Sure, that's actually a great
sales tax?
yeah, that's a great question. The traditionally, so our federal GST has been around for about 25 years. It came into play in 1990. Um, I guess that's 35 years. Um, so traditionally, whether it was for GST or provincial sales tax purposes, the test was typically, is your organization carrying on business in Canada, or are you carrying on business in one of the PST provinces? So that's something similar to like a nexus test in the US. So typically we were looking at, does your, simply coming to Canada as a US business and having sales in Canada wasn't typically enough. We used to look at things like, did you have employees that were physically in Canada performing services? Did you have a Canadian permanent establishment? Did you have a Canadian bank account? Were you, concluding contracts in Canada, taking payment in Canada, all those sorts of things? Were you actively soliciting work in Canada? So traditionally, that was the test in Canada. Um, Wayfair kind of came and went in the U.S., and in Canada there were some politicians that took note. And starting in around 2019, the province of Quebec first created these new what they referred to as a simplified registration regime. And it worked so well in Quebec that the federal government followed suit with the GST, HST, and then all of the other provincial sales tax provinces have implemented their own similar regimes. But really, what I'm talking about is under these new simplified regimes, we typically called them the Netflix tax in Canada. That's colloquially what it was known as. So we were talking about, or what we have in Canada now is almost like a two-pronged test for determining registration status. So there is the old traditional carrying on business test, but now there is this simplified regime in pretty much every taxing jurisdiction in Canada that says, really, let's look at what goods or services you're providing through electronic commerce means, so through electronic platforms. And if you're providing those services to um, consumers, not necessarily businesses, but to consumers in Canadian jurisdictions, you may have to be registered for GST, Quebec sales tax under these new simplified regimes. And like I said, the PST provinces all created similar rules as well. But essentially, we went from, hey, are you carrying on business in Canada to, okay, even if you're not carrying on business, you may still need to be registered under the simplified regime if you're making essentially sales into Canada of, through electronic means to consumers who otherwise would be paying tax. So um, I did mention we referred to it as the Netflix tax, and really what it was if you thought about it as an example, um, all of the big cable service providers in Canada would be charging, consumers, call it $100 a month plus HST plus Quebec sales tax in Quebec, those sorts of things. And that's what consumers did. They acquired those services, they paid tax on those services on a monthly basis. But if consumers, as the digital economy started to grow, as more and more non-resident companies who weren't really carrying on business, so then Netflix type organizations of the world, as they started to have sales into Canada, there was a realization that, hey, these non-resident companies aren't carrying on business in Canada, so they're not required to be registered for HST or GST. So they're not necessarily charging tax on their services. So while consumers were happy not to necessarily be paying tax on those services, governments were realizing a loss of revenues, and sort of competitors that were based in Canada were complaining because the competition didn't have to charge tax. And you've got some jurisdictions that the tax rate is as much as 15%. So it is a sizable amount and can make a big difference in a competitive market.
So is the threshold really kind of arbitrary, or is there some kind of, like we have in the US, right? All these states have the rules around, some kind of bright line number, right? $100,000 or whatever their number might be. How does Canada look at that?
Yeah, that's a great question. So in Canada, there is for GST, HST, so for the federal tax, there is a bright line test. It's $30,000 in sales in Canada over, we'll call it over the past year. It's technically over the past previous 4 calendar quarters, but over the last year, it's a $30,000 test. For Quebec's QST, the test is similar. It's $30,000 in sales into the province of Quebec. Now, for both of those taxes, it's a little bit academic how you're going to calculate the $30,000. If you're under the traditional carrying on business test, you're looking at all your sales. If you're under one of the simplified regimes, you might only be looking at your sales to end consumers.
Mm-hmm.
So
Okay.
there's some nuances to that. But then when you get into the provincial sales tax provinces, it gets a little trickier. They don't really have a clear bright line test in the way that the federal government does. So in BC, Manitoba, or Saskatchewan, you could be tripped up as early as your first sale into those provinces.
Wow.
Yeah.
Okay. And then how does that kind of relate then to the income tax?
Well, so from an income tax perspective, I generally don't get too deep into the income tax rules with most of my clients. I try to pass them off to one of my colleagues who specialize in those areas. But I will say, like, there are tax treaties sort of between a number of countries. So
Sure.
um, what I try to remind folks is that you'll have your income tax compliance that you'll have to take care of as a matter of recourse. As a general statement, though, none of the tax treaties really impact Canadian sales taxes. So
Yeah.
whether or not you really have to register for Canada's GST or British Columbia's PST, really, there are no real tax treaties that impact that. It's more of
Sure.
a test
Yeah.
of what are you doing in the country or in the province,
Sure.
and do you have to be
Sure.
registered? So
Right. Yeah, because I mean, one of the things that we talk to our clients about, right, is from a state perspective, so many of our states are being more aggressive and looking at sales tax registrations and then saying, "Oh, where's your corresponding income tax filing then?" And so I wasn't sure if, Canada was maybe taking some of those same, um, tips from the states.
Yeah, I don't think we're seeing that as much. I think we're probably seeing it the other way in that
Mhm,
we're figuring out that people have filed something from a corporate tax perspective, or perhaps more so from an import perspective.
mhm,
If there's you know compliance that's happening at the time goods are being imported into Canada, that might be leading the CRA to ask questions about
Gotcha,
sales tax registrations.
gotcha.
And that actually leads me to a thought I just had as well. So we talked a little bit about Canada's got our federal GST, and it's a recoverable tax. So really, um, any business, whether it's a Canadian-based business or a foreign-based business, if you're registered for Canadian GST under the traditional method, you would charge GST or HST. I'll use that term interchangeably. You charge GST on your sales to your Canadian customers. Um, But as an offset or a credit, you would actually get to claim credits for any GST or HST you've paid in the course of selling those goods or services. And one thing that I find a lot of businesses don't appreciate is that, so we have the GST that applies on transactions, and people can get their head around that, right? You imported some goods into Canada and you sold them to a Canadian customer and you had to charge them 5% GST or 13% HST. Fine. People understand that. What they often don't appreciate is there's also GST triggered when the same goods were imported into Canada. So typically goods get imported into Canada. There's a 5% GST that's charged and collected by the Canada Border Services Agency. And then, you've got somebody who's ultimately supplying or selling the goods somewhere in Canada and having to collect the tax. So you'd have the tax you've collected on your sale, but you'd have the tax you paid at the time of import. And you do get to claim credits for the tax you paid at the time of import. So I've run into a lot of organizations that frankly don't appreciate that they've paid GST at the border and don't
Mhm,
realize that it's a recoverable tax they've paid at the border.
gotcha.
Is there any way to not pay tax at the border? And where I'm thinking of this, right, is the US has, a use tax concept such that, if you're purchasing a taxable good and sales tax wasn't charged, that you then have to kind of self-assess use tax. Is there that kind of corresponding concept in Canada? And maybe it could be more applicable to like digital goods of services, that maybe that obviously weren't shipped and had to make it across a border, but is there that concept?
Yeah, so there are a few things to think about there. So if you've got physical goods that are coming across the border, um, at the end of the day, Canada Border Services Agency is going to collect GST or HST on those imports. So CBSA will only collect 5% GST on commercial imports, but everything commercially coming over the borders is getting taxed. It's effectively part of the customs import duties process. So when everything else is being processed to bring the goods in, one of the things that's in the paperwork is a 5% GST. And that's, I think, in part why some people don't appreciate that it's there, is because it just kind of gets paid along with some of the processing, and often it's done by the customs brokers, right? So people may not even realize they've paid tax.
Yeah, we've had a lot of clients kind of come ask, and it's like, well, do we have to register for Canadian, GST, HST, et cetera? And it's like, well, we've been shipping stuff into Canada for years. It's like, well, maybe look at your UPS contract
Yeah.
or FedEx because it's probably buried in there. If you don't
Yep.
affirmatively know if you're paying it, it sounds like your goods are not coming into the country without it being,
Correct.
that 5% being
Yeah.
collected in some capacity.
Yeah, that's right. So the 5% is absolutely being collected at the border. I mean, there are zero rating provisions, so there are some products that can be sold in Canada non-taxable. So a broad, simple category is a lot of basic groceries. So produce is a good example. So produce coming into Canada would not have the 5% GST levied at the border. But, typical business assets, parts for, equipment, anything like that, inventory, generally, that's all going to be taxable. Now, there are, you know, I do love to explain to people, and like all good tax legislation, the Excise Tax Act is the legislation that creates the GST. The GST is created in literally one sentence, and then there's 2,000 pages of tax jargon and special rules and all kinds of good stuff that goes with it. So there are some provisions that do allow. Um, there are some instances where people can import goods into Canada, pay GST at the border, and pass along that GST to their customers and allow their customers to claim it as a credit to recover it. But the processes are a little more cumbersome than you would think they should be. So I'm always kind of hesitant to throw that out there cavalierly. But there are some processes to help people recoup tax that was paid at the border if the importer of record wasn't a GST registrant. The other thing, so I normally get, when I get the question from non-resident businesses, are we required to be registered for GST? Well, there's a short answer that, well, we have to do a carrying on business test, or we have to look at that simplified.
It depends.
It depends.
We love that answer.
Yeah, I know, right? But the other thing is that because GST is recoverable, there is a side piece that says, hey, even if you're not required to be registered, you might actually want to be registered, right? So if you're importing goods into Canada and we've decided, no, you're not carrying on business, so you don't have to be registered, but maybe you are paying a bunch of GST at the border, or maybe you are paying a bunch of GST on, warehousing fees or something like that. Like, there might be some value in being registered to get back the tax you've paid in the course of your operations in Canada. The other piece of advice I often end up discussing with clients is, and again, not to be completely cavalier, but if you're uncomfortable with the Canadian tax rules, you can structure your transactions so that they occur outside of Canada, right? So if there's a scenario where US based, if there's a company based in Buffalo and they don't want to be the importer of record and they don't want to handle sort of, or be concerned about Canadian sales taxes, there might be ways to restructure their agreements to say, hey, look, we'll sell all this stuff. We'll sell it at our dock in Buffalo, and you, Canadian customer, can be the importer of record, and you can handle all of the Canadian tax, and we'll just stay outside of the regime by staying outside of the country. So I do end up with a lot of clients sort of thinking about those sort of concepts and how they might be able to avoid being caught up in Canadian tax rules as well.
So sometimes we hear about goods being stuck at the border. What are some scenarios where that happens?
Yeah, I think the biggest challenge at the border is just poor importation paperwork. And so it's not necessarily tax related, but it could be customs and duties related. And it often probably has to do mostly with goods being improperly declared. So goods being poorly coded. All goods coming into Canada have an HS code. So they're identified as a particular type of product for customs and other reasons. And if they're if the paperwork is improperly filled out, I think that's probably what gets things stuck at the border most frequently.
Okay.